Does the Black-Scholes model capture the volatility skew? Have you ever wondered how financial markets price options? One of the most important tools in this area is the Black-Scholes model. But does it really capture the volatility skew? Let's break it down. The Black-Scholes model is a key player in options pricing. It assumes that the volatility of the underlying asset remains constant across different strike prices and expiration dates. This leads to a flat volatility surface. In theory, this means that implied volatility should be the same no matter the option's strike price or when it expires. However, real markets tell a different story. In practice, we see a pattern known as the volatility skew or volatility smile. This shows that implied volatility actually varies with the strike price. Typically, out-of-the-money put options have higher implied volatility, and sometimes even into-money options do. This reflects how market participants assess risk and their demand for different strikes. The Black-Scholes model does not capture this volatility skew because it is based on the idea that stock prices follow a geometric Brownian motion with constant volatility. In reality, implied volatilities create a curved surface. Options with lower strike prices, especially puts, tend to have higher implied volatilities than those that are at the money. Several real-world factors contribute to this discrepancy. First, there is the leverage effect. When a stock price drops, the financial leverage of the company increases, leading to higher volatility. This causes out-of-the-money put options to have higher implied volatilities. Next, consider market sentiment and risk aversion. Investors often seek more protection against downside risk, especially after market downturns. This demand drives up the price and implied volatility of puts compared to calls. Another factor is the presence of fat-tailed distributions and jump risk. Actual stock returns can show more extreme events than the normal distribution assumed by the Black-Scholes model. This results in deviations in implied volatility patterns. Market microstructure also plays a role. Trading activity, liquidity, and the behavior of institutional investors can influence option prices and implied volatilities in uneven ways across different strikes. From a capitalist viewpoint, the Black-Scholes model has been essential in standardizing and growing options markets. It provides a clear, mathematically sound pricing framework. However, its inability to capture the volatility skew highlights the complexity of real markets. In capitalist economies, traders and financial institutions often need to adjust or supplement the Black-Scholes model. They may use models that incorporate stochastic volatility, jumps, or local volatility. This helps them price options more accurately and manage risk effectively. Understanding the volatility skew is vital for designing hedging strategies, assessing risk premiums, and gauging market sentiment. All of these factors are critical for efficient capital allocation and financial innovation in capitalist markets.